Hello, everybody, and welcome to VRIC Media, the most trusted voice in junior mining. Our flagship event is just around the corner. The Vancouver Resource Investment Conference is January 19th and 20th at the Vancouver Convention Center. Best of all, tickets are free. Get yours by clicking the link in the description below. But of course, we are bringing the VRIC to you with our series of expert online panels. I'm very excited for the one we have lined up for you today. We have Leigh Goehring and Adam Rozencwajg, managing partners of Goehring and Rozencwajg, an investment firm dedicated to researching and investing in the natural resource industry. We're going to discuss a variety of commodities. We're going to talk about uranium, gold, copper, energy, and a whole lot more. Gentlemen, it's great to have you back on the show for part two.
Thank you very much, Jesse. We're very glad to be back on the show with you.
Well, I want to start off before we dive into individual commodities to look more broadly at the commodities sector as a whole and ask what are the main themes and trends that you're watching at the moment when it comes to commodities that you think investors should be paying attention to. And Leigh, I'll start with you on this one.
Okay, Jesse, I think one of the big thematic elements surrounding global commodity markets today is the fact that commodities in general, and that it's almost all commodities, remain in what we'd like to call a radically undervalued state with no investor interest whatsoever. And the thing is that disinterest has produced the tremendous opportunity that exists in these markets. And what's interesting is I'm a firm believer that we're repeating the period from the mid 1960s all the way to 1971 to 1973, and then we'll repeat the 1970s commodity bull market in general. But if you remember, in the late starting in the late 60s all the way into the early 70s, we had an investment backdrop that was very, very similar to today. Back then, you had the development of the Nifty 50, which is almost a direct mirror of what is going on today, first with the FANG stocks and then with the Magnificent Seven today. And no one had any interest in what was going on in the underlying commodities, even though radical things were indeed taking place. And then two events came, black swan events came up upon the investment scene. One is that Nixon, in the summer of 1971, removed the U.S. from the Bretton Woods Gold Exchange Standard and let gold float freely, and that started a huge bull market in gold, which at the time was not really recognized as the impact of what that huge move in gold, what it represented. And the craze in financial stocks continued with the Nifty 50. And then what happened is that in September of 1973, we had the Arab oil embargo, and oil prices literally in 1 week went from $3.50 up to $13 to $14, which was a huge shock to the global financial system. And I think that we're somewhere between 1971 and 1973, and we're seeing we're seeing the parallel move in gold. Gold has entered into a bull market just like it did in 1971. It's telling you something is happening. It's telling you we're getting closer and closer to a huge change in investor psychology towards commodities, and the recognition that they're radically undervalued. The new bull market is about to start.
And Adam, your thoughts. And also, I'd like to get your take on the current valuation of the broad market as we continue to see, it's maybe down a little bit the last couple of times, but performing very strongly. Could we see a bull market in commodities alongside, the indices and the broad market? Or do you think the broad market really needs to break down for that capital to go into the commodity space?
I think realistically, the market probably needs to sell off to see a sector rotation into the commodity space, just because what we're seeing across really every commodity subsector, like Leigh was talking about, is money being sucked into other investment ideas, other investment themes, mostly at this point centered around things like AI and data centers and things of that nature. And so I think so long as that continues to work and propel the broader market higher, I don't think you'll get the catalyst to really move. I mean, strictly speaking, you certainly could have money come back into the resources space alongside a broad market rally. But I think realistically, what's probably going to happen is that once some of those stocks begin to lose their luster, you're going to see a huge sector rotation into this space. And one thing that I just want to kind of add on, because I think it's an important distinction, Leigh was talking a minute ago about how cheap commodity stocks are. And by every measure, they're as cheap as they've ever been, whether you look at gold stocks or energy stocks or other mining stocks, they're all incredibly undervalued and investors have very, very little interest. And as value investors, that's really exciting because it creates a huge opportunity. But there's actually something else at play. Strictly speaking, a value investor likes a value stock because you're able to buy a dollar's worth of assets for 50 cents. But in the resource space, there's a second reason I think you want to be a value investor. And a second reason why today's huge value opportunity is so bullish. And that is commodity deposits deplete. And oil fields and copper mines and gold mines and iron ore mines, even over a long enough timeline, they begin to suffer depletion problems. And so what we've seen time and time again in these really strong commodity bear markets is we see a lack of investor interest and a lack of investor capital going back into the ground to develop the next generation of deposits, the next generation of mines. And depletion begins to take hold slowly at first, and then all of a sudden you hit this tipping point. And what you realize is that without the investor interest and without the money being spent and put into the ground, you can't make the discoveries. And then with a lag, you can't bring on the new supply to offset depletion. So not only is it a good setup because you're buying at attractive prices, but actually it signals a fundamental bull market because I think there'll be major supply responses. And we've seen that in every commodity bull market in the last 150 years. It tends to repeat the same pattern, which is a mania somewhere else in the market. Money gets pulled out of the resources space, usually after a period of overinvestment. Supply begins to tighten slowly at first, and then all of a sudden you hit that tipping point where demand is really accelerating much more than supply and might actually be decreasing. And you then re-rate things higher as prices have to move, often quite violently to attract that capital in a hurry to come in and shore up the supply side. That happened in the late 20s. It happened in the 1960s through the 1970s. It happened following 1999 into the middle 2000s. And by every measure, the amount of CapEx being spent now, the weightings in the index, all those things are lower today than they've been in any of those other times. So I think not only is it a good buying opportunity just on the price, but I think it's actually setting up a fundamental bull story here because of supply constraints. And that's what we're beginning to see already.
Well, I want to start with a commodity that you're not as bullish on as a lot of other people out there, and that is copper. Your latest market commentary is titled Copper and Uranium, the Coming Divergence. The vast majority of people I speak to on this show about copper are very bullish, citing how much copper is needed for electrification, for the energy transition, the current number of producing mines. That production falls far short of projected demand, and so a rise in price seems inevitable. You have a bit of a different view, so walk us through that. And Adam, I'll go to you first on this one.
Okay. Well, I think there's really two things that give us a little bit of pause on the consensus bullish view on copper. And first is just that, is that there are a lot of copper bulls out there. Now, it's not necessarily reflected in huge capital flows into the copper space. We're not seeing, massive money being put to work for new copper deposits, but it's certainly not as out of favor something like, let's say, oil, natural gas, or frankly, even, uranium. I know it might be a weird thing to say because uranium's had quite a run in the last couple of years, but in terms of, where uranium prices are relative to replacement cost and stuff, we're just now getting to the point where it makes sense to even think about kind of new mines over the next 5 to 6 years. So there's more of a consensus bullish view that's formed around the copper space. That always gives us a little bit of pause. We like to joke, not to pick on, McKinsey and what have you, but when McKinsey comes out with a huge report talking about the coming sure copper boom, that's usually a good sign to run the other way. And sure enough, in the last couple of years, we've seen reports from several consultants, and S&P Global came out with a massive report that's widely cited and things like that. But on a more fundamental level, I think there's really two things that give us a little bit of pause in the copper market. And that is on demand. A lot of the demand expectations for copper for the next 5 to 10 years really are predicated on the renewable boom. And we've become very, very critical, as we've talked about in the past and written about a lot. We've become very, very critical about the potential for renewable energy to make widespread inroads. And the reason for that, and again, if I'm going too off topic, just pull me back. But the reason for that is their very poor energy efficiency. Any energy system that you look at, I think it's critical to look at how energy intensive it is to produce the energy that it produces. I mean, at the end of the day, what you need out of a energetic system is useful power, and how much it cannibalizes of its own power to create that power is obviously very, very critical. And we've seen over time and over hundreds, if not thousands of years, energy technologies displace old ones when their energy efficiency is better. We went from an agrarian lifestyle to burning coal because it had better energy efficiency. We went from coal to natural gas and super high temperature combined cycle gas turbines because the energy return on energy invested is better and better and better. And in the case of renewables, they're much, much worse because, it's no, I think, great surprise that the density of the sunlight or of stiff breeze is nowhere near the energy density of burning natural gas. If you put your hand over your stove on your gas burner, it's not the same order of magnitude, even on a really, really hot day, putting it sort of out in the sun. And so to get the same amount of usable power from something that's much less dense, well, you need to make everything much, much bigger. And that's why a gas plant can be quite compact, and a solar plant takes up acres and acres, and wind farms as well. And all of that infrastructure and all of that equipment requires materials, and those materials in turn require energy to manufacture them. So when you look at the total energy return on energy invested for something like natural gas, it might be 30 to 1. So if you put in 1 unit of energy to drill a well, get the gas up, strip it of liquids, process it to the extent you need to, build the combined cycle gas plant, which is then amortized over its life, and generate all the electricity, for every unit you invest, you're getting up to 30 units of energy out in the form of electricity. For renewables, it's as low as 10 to 1. And when you start to back it up with batteries, you're down to potentially 5 to 1. I mean, that's as bad as pre-industrial revolution, agrarian style economies. And frankly, I don't think it's possible to go back. And we see that, you can't run the modern industrial world on renewables. That's why Germany, the countries with the biggest renewables push, are now in the process of deindustrializing, because you simply can't run a modern industrial economy on something with an EROI that's as good as it was in the 15th and 16th centuries. Uranium, on the other hand, is incredibly energy efficient. And that's why we kind of put those two commodities together in that essay and talk about the coming divergence. Its EROI is 100 to 1. So 3 times better than the current best, which is fossil fuels, no CO2 emitted, and potentially with the small modular reactors, which we can get into here in a second, could be as high as 180 to 1. So, massive, massive improvements instead of a massive degradation. So I think when you look at the next 10 to 15 years, and it's happening already, you're seeing the bloom come off the rose a little bit on renewables and more of a focus on nuclear. And with that, frankly, there's less copper that's going to be demanded. So everyone's numbers that have huge build-outs of wind, solar, and electric vehicles, I think, run the risk of being disappointed. I'll take a break there and see. Leigh, do you want to add anything?
Yeah, I think Adam very, very well captured our feeling on that. We believe that the huge copper demand assumptions going forward between now and 2035 are radically overvalued. For example, Adam referenced the S&P copper report, which I like to say that's the gospel for almost all copper bulls. They believe the copper demand between 2023, which is basically about 25 million tons of copper a year, was going to basically double to 50 million tons, of which half of that 25 million ton increase in copper demand was going to come from renewables. And we believe that 20 that 12 million, 13 million ton renewable increase is radically off the mark. And is also, as Adam said, we have been very, very critical of renewables and their ultimate ability to displace either hydrocarbon or ultimately what's going to happen is nuclear power in a global power generating basis. And And what's happening right now, and we've written about this and we've actually predicted it, is because of that tremendous, uh, you know, gross energy inefficiency in renewables that is going to have all these unintended economic consequences and side effects, and we're seeing them right now. The huge crisis that's beginning to develop in Europe regarding high power costs, high electricity costs, and how it's impinging their economies, and severely hobbling their economies, is 100% related to the adoption of renewables. And we've been a big believer of it. We studied it and we predicted it, and now it's beginning to happen. And so what's going to happen is we're going to realize that renewables are not part of a solution. They are part of a terrible problem. So all of a sudden, 12 million tons of copper demand that everyone has in their models between now and 2035 is a lot of it's going to go away, if not entirely disappear. So that's a demand headwind. But there are other things in the copper story too. That are interesting. We're on the verge of a whole introduction of disruption technologies in the global copper business that people are not paying any attention to whatsoever. For example, there's been a lot of talk about how we've run out of the discovery of large copper deposits, and that's true. However, that's based upon an interesting reason, in the sense that the hard rock mining industry, doesn't have the technology to make deep deposit discoveries like the oil and gas industry does. I mean, the oil and gas industry can image potential hydrocarbon deposits that are in 10,000 feet of water deep and another 20,000 feet below the ocean bed floor. And literally, in the hard rock mining industry, the exploration tool that's still the most widely used tool is a geologist running around on surface with a pick hammer and a grab bag, and he's just saying, "Oh, well, I think that there's a soil anomaly over there, or there's a rock anomaly, and I'm going to go over there and bang and put it in my grab bag, and then we'll assay it. No, yes, and that's a copper deposit." I know that sounds silly, but that's really how most copper deposit discoveries are made today. However, there is a development of several technologies, primarily one technology, the iPulse technology being developed by Robert Friedland and Ivanhoe Mines, which has the potential to completely revolutionize the way hard rock mining deposits are discovered going forward. For the first time, we are now going to have the ability to see more than 200 meters below the surface of the Earth. We can image hard sulfide deposits, a kilometer, 2 kilometers deep, and this is going to be a huge revolutionary issue, and the disruptive technology. And so, there's all these things happening. First, the demand side is going to disappoint. We have no doubt about that. But there's the potential for some huge uh, potential disruptive technologies that are going to be induced on the supply side. So you could make, we're bullish short term on copper because the underlying fundamentals today in the copper market are very, very positive. The market is in structural deficit today. However, on a longer term basis, I think that these are trends that we have to watch, both on the demand side and the supply side. And one further comment on copper is that, if you go back starting, oh gosh, 10, 15 years ago, one of the speculative community's obsessions was the fact that China was over consuming copper, and that China's copper consumption levels were unsustainable. And that was based upon what we believed was flawed modeling. And we came up with a completely different way of modeling Chinese copper demand based upon the copper-based installation needed to support certain levels of per capita GDP. And we found, we said, a decade ago, 12 years ago, that China is not overconsuming. In fact, if they're going to want to hit $12,000 to $15,000 of copper per capita GDP, they're going to have to significantly increase their copper consumption, which is exactly what's happened. Now, however, what's so fascinating is that for the first time in the last almost 25 years, based upon our modeling, China is overconsuming copper, even when you adjust for the huge investments they're making in their renewable base today. And what's so interesting is that all those people that over the last 15 years, we're screaming and yelling, China is overconsuming copper. Now that it actually is, you don't hear a peep from anyone. Which again, it's another potential bearish point that China is overconsuming copper for the first time in the last 25 years. Now, there's other positive things. India is definitely going to ramp up huge in the next couple of years. We're starting to see that already. But China consumes almost 55%, 56% of world copper. And still a huge force in the market. So that's another potential disappointment that could play out in the next couple of years.
Well, let's talk about uranium. As you previously predicted, Kazatomprom, the largest producer in the world, has released guidance that indicates they are falling short of previously stated production forecasts. Now, Inkai, their JV with Cameco, seems to be in question. Apparently, some paperwork was not submitted on time. Don't know exactly what's going on behind the scenes there. We've seen Niger experience a coup where they've shut down GovEx's operations. They seem to be ousting Orano and taking control away from them in the region. Global Atomic is obviously there working towards developing their project, but that is also a big question mark. In Canada, we have massive permitting times. I mean, across the board in the industry, I've spoken to CEOs who have straight up said we're having a very difficult time finding talent to work in this field because so few people are interested in it. And those people who have expertise are all retiring or retired. Where is all this uranium going to come from that we need to power the growing nuclear fleet? Leigh, I'll go to you on this one first.
Well, just you bring up an excellent question. The supply is there, but it needs higher prices because, as Adam mentioned before, we're $75 spot term price today. That's really the base price that you need to bring back a lot of this marginal supply. And when I speak marginal, I talk about, the United States. The U.S. used to be the world's largest uranium producer. In 1980, I think we produced 35 million pounds of uranium. We produce zero today, or a little bit, but it's almost zero. And to bring that 30 million pounds of uranium back, you need a minimum of $75, and a higher price would actually help. So you need higher prices, and you need time. I mean, we're going to see a supply response in the uranium business, but it's going to take time for these huge projects. The big projects to watch now are going to be the NextGen's Arrow project up in the Athabasca Basin. Now they're still talking about 2028 bringing that project on, and I would say that's going to be impossible. That's going to be a project that's going to come on probably about 2030 or 2031 and things like that. And that's a big slug of supply. That's 25 million pounds. But once you get outside of that, it's drib and drab here. There's 2 million pounds there. There's 3 million pounds there. It's not enough to really fill in the whole. The big deficit that has already merged between demand and supply.
And Adam, any thoughts you'd like to add on the uranium situation at present?
Yeah, I mean, one thing that I think is really fascinating about uranium, and I think a little probably misunderstood, is that the market is basically in deficit today, and it has been for a couple of years. Why do I say that, and why haven't prices gone up more? I mean, well, to a certain extent, they have. They've gone from a low of 18 all the way up to a high of 100 on a spot basis. And today, you have spot prices, like Leigh said, at around $75, and term prices now actually up above spot prices for the first time in a number of years. But the market slipped into deficit a couple of years ago. And what had happened was that following the Fukushima earthquake and tsunami, the Japanese continued to take delivery of all of their contracted material. And it, in a lot of ways, sort of upset the market because they sent the wrong price signals into the market by being there and effectively taking their material and just putting it in stockpile. And in fact, Kazatomprom actually increased production in the years following Fukushima to sell material into a market where you were shutting down nuclear reactors left, right, and center because there were still these long-term contracts in place. And the market slipped into a primary deficit, which is to say that mine supply was no longer covering reactor demand a couple of years ago, but you had to work through all the secondary supply. and all these stockpiles. And that's all done now. And so the market is tight for the first time. But I think when people look forward into the next couple of years, one of the things that they miss is they say, well, how fast do the small modular reactors need to come online in order to really tighten this market? That's a story for the 2030s. The market's tight today. It's tight based on the current set of mines in operation and the current set of reactors either built and operating or planned and under construction over the next 3 to 4 years. And we need a couple of big mines to come online. And NextGen is obviously going to be one of them, and Kazatomprom. The hopes there was that they'll be able to increase production too, but both are very, very challenged. And so you have a market today that has been people have been uninterested in it for a number of years. There's now coming back to the space, but you're only today getting back to that incentive price. The banks, frankly, are still really reluctant to lend because you've had a sharp move in uranium prices higher in the last couple of years. People aren't willing to underwrite that yet. So I think it's important to kind of realize that this is not a market that has a healthy amount of investor flow coming into it, and it doesn't have a healthy amount of investor flow being put into the ground yet. And that's what really ultimately does end the bull market. So supply eventually will catch up with demand at some point. Uranium is not the most rare material. We know where there's deposits around the world, but they're going to take time. They're going to take higher prices. And in the interim, I think you're exactly right. It seems very, very unlikely that we'll be able to ramp production to meet the demand that we have today and the demand that's pretty firm in the next 3 to 4 years from additional reactors being built in places like China, as well as life extensions here in the West. So, I think that's kind of a misconception. Most markets, you have to look forward, project forward and say, I'm going to take a bet here based on when I see the market slipping into deficit and sometime in the future. The market's in deficit. The deficit's here. It's been here for a couple of years. It's been masked. You've had moments of investor euphoria that were capital comes in and then it comes back out again. We saw that, at the end of 2013, hedge funds buying a lot of uranium stocks and a lot of spot uranium. That's all been completely undone now. Investor interest is, I would say, as low as it's been in some time. And we have a very tight market for certainly the next 5 to 7 years. And then the question into the 2030s is, how fast do these SMRs ramp up? And they could ramp up much quicker than anyone expects. But that's, outside of the investment time horizon for most folks.
Well, let's pivot to oil and gas. One very interesting. Go ahead, Leigh.
Just
yeah.
I want to ask one point. Is that
Yeah.
I think you can't underappreciate that what's going to happen in the nuclear power generation, electricity generation business the next decade. And Adam mentioned the SMR. The SMR, it's not a new technology, but it's going to its impact on the nuclear power generating business is going to be monumental. And the reasons are for that is that, if you look just on energy efficiency, Adam touched on the fact that generating electricity from nuclear power, it's 1 unit of energy, to mine uranium, upgrade it, process it, enrich it, build a huge plant that turns that into electricity. That's 1 unit generates 100 units out the other side. It's off the charts, 3 times more efficient than hydrocarbons, which are incredibly efficient. So the question is what has happened? Why hasn't nuclear power displaced hydrocarbon generated power or other forms of power generation? And the answer has to do with a decision that was made back over 75 years ago in the U.S. Navy on what technology do you use to adopt for submarines and aircraft carriers with nuclear generating facilities. And they decided, Admiral Rickover decided back then that he could have done molten salt, but he decided to do high pressure water. And the reason why he did that is that molten salt, when it comes to contact with water, is highly flammable. And so he decided, hey, we're operating in a marine environment. Molten salt is not applicable to what we do. We have to use high pressure water. Now, the interesting, and ever since then, everything in the world, as far as power generation from uranium sources, has been high pressure water. Except that doesn't make, other than you're operating on an aircraft carrier or submarine, it doesn't make a lot of sense. And the whole new generation of SMRs, which are going to be based on molten salt technology, are going to bring 2 things to the nuclear power generating business. One is that it's, as Adam pointed, it's close to almost 100% more efficient than generating electricity from high pressure water reactors. The reason is you need 90% less steel and 90% less concrete to build those facilities. And that's incredibly energy intensive. Don't forget, 20% of global CO2 comes from steel making and concrete making. And the thing is, you're going to be using a huge amount less of concrete and steel. And the reason is it's the fact that water boils at 100 degrees C, molten salt boils at I think it's 1,200 degrees C. And the core reactor never gets above 600 to 700 degrees C. So molten salt will never boil, even if you lose circulation. And so therefore, it doesn't have to be kept at high pressure. So not only is it more efficient, but it's also much safer than a traditional nuclear reactor, because the idea is it's operating at atmospheric pressure. You don't have to worry about the loss of circulatory pressure, which would then cause water to boil off and then cause a core meltdown. And so the SMR based upon molten salt based design is much, much safer than a high pressure water reactor, which, mind you, a high pressure water reactor is infinitesimally safe. Other than other than Chernobyl, there's never been a death or accident associated with a nuclear power plant. Now, let me just put that in the right perspective. This is a statistic that no one uses. There are approximately 250 people killed a year crossing train tracks in America. 30% of train traffic is coal. So that means that coal-related generating facilities kill approximately 70 people a year. And here's a technology that's been operating for 70 years, has never killed anyone other than Chernobyl, which, mind you, Chernobyl didn't have a containment vessel, and it was a dual purpose plant, generating nuclear grade fuel and generating electricity at the same time. Never do that in the West. And so it's not only going to be more efficient, people are going to realize that this is very, very safe. You could have one of these things in your backyard. And it's people we're firm believers that people are going to accept this, and the fact that we're going to have a efficient and extremely safe way to generate electricity with zero CO2 output. And it's being recognized right now. You see it in the fact that all these data processing center operators are all, the big one is the last one was Meta with its agreement with Okla to, basically buy 1.6 gigawatts worth of SMRs from them. And I think that there's a lot of regulatory issues that have to be cleared, but I think we're radically underestimating the impact of what molten base salt SMR is going to do to the nuclear power generating business and to uranium demand.
Yeah, some great points there. I do want to discuss oil and gas here because there was an interesting section of your recent commentary, The Depletion Paradox, which outlines why, quote, the great drama of American shale production may now be nearing its final act. Talk to us about your findings and how it could affect the oil and gas markets. Adam, I'll go to you for this one.
Well, in our last essay, it was really the culmination of a lot of work that we've been doing for quite some time on the shales. And if you go all the way back to the beginning of the shales in sort of 2005, we were some of the earliest investors in the shale basins. And we've always made it a goal of ours to understand the shales better than anybody. And that sounds like a bold claim, but we've understood their potential. At times underappreciated, how big some of them have grown, and at other times gotten it spot on. But we've always been at the absolute forefront of the shale revolution in the US. And one of the things that we've been fascinated by was a lesson that really investors ought to have learned 10 or 15 years ago, but they didn't. And that is that even though the shale basins are these huge, huge fields and really big aerial extents, and they can bring on large volumes of hydrocarbons, they exhibit a lot of the same characteristics as traditional fields, which is to say they don't go on forever. And eventually they begin to peak, plateau, and roll over. And we saw that in the first two gas shales, the Barnett and the Fayetteville, which were produced in Texas and Arkansas, respectively, and they rolled over, long ago in 2012 or so, and are now 65 to 70% below their peaks. But the reason investors didn't really care is that just as those fields were rolling over, these massive fields, both gas and oil, the Marcellus, the Haynesville on the gas side, and the Permian on the oil side were coming in, and they eclipsed any of the declines in these kind of relatively smaller fields. However, that doesn't mean there weren't lessons to be learned. And the big lessons to be learned is that shale basins are just as predictable as traditional sandstones, and we can start to apply some really interesting studies, statistics, and ultimately artificial intelligence to begin to predict when they'll roll over and decline. And the work that we have sort of leaned on was, the work from the shell geologist King Hubbert from decades and decades ago. He first made his prediction in the late 1950s, talking about when he expected U.S. conventional production to roll over. And he made this big, bold claim saying it would roll over in the early 1970s. And he was spot on, both his timing and the level, the volume of daily production at which it rolled over were pretty correct. And the work that he did was based upon two ideas. One, there's a relationship between how much reserve is in a field, so how big the oil field is under the ground before you've ever drilled a well, and what it can hit in terms of max production. Stands to reason, if you have a much bigger field, it probably will produce more than a much smaller field. And second, it was his work that suggested or predicted that a field would begin to roll over and decline once half those reserves had been produced. And that's kind of the famous Hubbert peak. And those views have come in and out of favor over the years. It obviously became very important in the 1970s when the U.S. did roll over. It was then sort of lost in obscurity through the 90s when areas like the North Sea and Gulf of Mexico came online. And then regained some prominence in the early 2000s when we started to see a massive slowdown in non-OPEC oil supply growth. And Leigh wrote a really, famous article back in the early or middle 2000s that was featured in Barron's, where he said just that, I have this prediction that non-OPEC oil supply growth is going to stall. It was based on the work of Hubbert. And so the question then is, how can we apply that to the shales? Can we use, now that we have two basins that have already rolled over, now that we have kind of a framework, can we use that framework to begin to understand and predict when other basins might roll over? And part of that was understanding how big the shales were. What were the ultimate recoverable reserves of the shales? And that proves to be very, very difficult because every shale well is a little bit different. They're much bigger in their aerial extent, so they go on for hundreds of thousands of acres, whereas conventional fields are much smaller. But each individual well, based on the geology of the shale, can be quite a bit different. Whereas in a conventional reservoir, you have fewer wells, a tighter area, but the variance in good wells and bad wells is certainly not the same. And so we turned to AI and machine learning, and we did that all the way back, started in 2019. So we've been doing this a long time, long before large language models kind of came into vogue, but a lot of the same technology, these deep neural networks and other machine learning tools. And we tasked it with a very, very specific request, which is to say, given how you drill a well and where you drill a well and the geological properties under the surface of where you drill, what will the recoverable reserves of that well be? And if you think about, how good AI has gotten at mimicking human behavior and all these really abstract, complex tasks, asking it to do something as simple as that should be pretty easy. And the results were actually very, very accurate. And so from there, we were able to say, okay, how big are these shale basins? How much will they ultimately recover? And when do we think they'll begin to roll over? The other thing that we came away with, which was sort of fascinating, is that shales are a little bit different than conventional fields. And so they don't necessarily roll over at 50%. In fact, what's a little bit strange is they roll over at only kind of 30% depleted. Now, why would that be? Well, a different way of putting it is they have a long stretched right tail. So they don't kind of form this bell-shaped curve where they decline very, very sharply. They have a kind of more prolonged, gentle decline on the right side, which you would think, means that there's more recoverable reserves. It does, but it also means that the peak happens earlier in the total recoverable reserve profile. And putting it all together, we came to the conclusion, and we've been refining it ever since, that 2024 would likely be the year that we would see major peaks. I mean, most of the shales, frankly, have already peaked. The Barnett has peaked. The Fayetteville has peaked years ago. The Eagle Ford and the Bakken have both peaked pre-COVID. The only ones that are still showing signs of growth are the Permian and the Marcellus. And we made the prediction that we thought both of those would decline in 2024. And they have. So shale production is now down year on year. It made a high water mark in November of 2023. And by the end of 2024, we're now down year on year, down a couple 100,000 barrels on the shale oil side of things, and down nearly 5% on the U.S. natural gas side of things, which is something that very, very few people have commented on, was that last year was a really sharp year of declines in U.S. oil and gas production. And U.S. oil and gas production has really been the only bright spot on the world stage in the non-OPEC world. And so that's going to be a really, really big shift here as we go forward, because we've enjoyed 15 years of really strong, robust U.S. growth. We estimate that basically 90% of all new demand over the last 15 years has been met by new shale barrels and shale MCF. That's not going to be the case here going forward. So I think everyone right now is in a little bit of a confused mood. I think most people that we talk to think that if we get a little bit more investor enthusiasm and a little bit more higher prices in both oil and natural gas, we'll see a huge surge in shale production again. And our view is that you're going to put your foot on the accelerator and you're not going to have that pickup. Is that you're not going to get the big resurgence. And that is going to be a pivotal moment of reckoning, I think, for global energy investors. And that now looms here ahead in the coming weeks and months.
Fascinating. And I highly recommend people read that full market commentary. There's a lot of insight there, deeper insight, some charts. Very interesting, the AI models you're using as well. Leigh, let's turn to the precious metals markets now, because in the commentary, you also noted that it seems like Western investor sentiment in the precious metals space seems to be turning. Now, interestingly, when we look to countries in the East like China and India, it seems like your average person is much more in tune with the fact that gold and silver are historically money, whereas in the West, people look at it as some kind of collectible or something, if you ask the average person out there. What are the catalysts that you think could make sentiment shift to where we see more Western retail participation in the gold and silver space?
Well, one of the interesting things about the Western investor, Jesse, in the gold market is that if you go back and study, since gold has been freely traded starting back in 1971, that Western investors are severely impacted on their gold buying behavior by real interest rates. When real interest rates go up, the Western investors become sellers of gold. And when real interest rates go down, Western investors become buyers of gold. And this is explained just about every gold behavior move by Western investors, like I said, going all the way back to 1971. In the cycle over the last 10 years, real interest rates started to go up back in 2011 after the financial crisis. And not so much the interest rates went up, but inflation went down. And so gold investors between 2012 and mid 2016 became huge sellers. In fact, if you look at you can track we track 18 physical gold ETFs on a global basis. And from end of 2011 to beginning of 2016, they sold 1,200 tons of gold. And then real interest rates from mid 2016 to the 2020 actually fell during that entire time period. And what happened is that Western investors tracking those same 18 physical gold ETFs accumulated 2,200 tons of gold. Now, since the beginning of 2021, real interest rates have been going up, and we've repeated exactly what happened between 2012 and 2016. Western investors from to the beginning of 2021 to the beginning of 2024 liquidated almost 1,200 tons of gold. Very, very similar to what they did in the previous period. However, this cycle's different. And how is it different? Back in 2011 to 2016, that 1,200 tons of Western gold liquidation forced the gold price to fall by 45%. This 1,200 tons of gold price liquidation from when it started to it ended, the gold price didn't fall 45%. The gold price was actually 10 to 15% higher. Now, how did that happen? Well, that's the central banks have come in as buyers. And of course, in the last couple of years, we've seen a huge surge of central bank buying. Basically, central banks are now, in 2022, 2023, and in 2024 were all record years for central bank buying of gold. Now, what is going on and what is causing that huge surge in central bank buying? Well, we believe and Adam mentioned before when he was talking about how this cycle is very, very similar to all the other cycles. The cycle that started in 2029, the cycle that started in the late 60s, the cycles that started in the late 1990s, and the cycle that we believe is starting today. In a sense, each one of those cycle beginning parts of the cycles was characterized by a major monetary regime change. And we believe we're on the cusp of a major monetary regime change. We don't know what it is. We can speculate it on what it might be. But the funny thing is there's something going on behind the scenes. And I think that something is the fact that the whole world is preparing itself for a significant and huge monetary regime change that is going to devalue financial assets, devalue money versus dollar versus gold and versus hard assets. And I think we're beginning to see that. And now what's interesting is that, okay, so now central banks have bought all that gold and then some from the Western investors. What happens if real interest rates start to go down, which they look like they're going down now? What's happening? Western investors now, starting back in April of this year, have turned into buyers. Now we've gone neutral again the last couple of months. But the funny thing is, it looked like we've now turned back into buyers. And the funny thing is, now you've got central bank buyers competing with the Western investor who has returned. And I believe that that's going to force the gold price higher. And I think that's going to be the world that we live in going forward. So central bank buying, which does not look like it's done. China just announced that I think it was December, that they bought another 10 tons of gold. They've been out of the gold market for 6 months, obviously because of the high price. They re-entered. And I think that you've got these two very, very large potential buying groups now. They're going to start competing for gold.
And Adam, do you have any thoughts to add to that? And I also wonder how you view Bitcoin at the moment. Are you watching that asset at all? Do you think that it competes for market share with gold at this point in time? What are your thoughts there?
I don't think we really have a lot to add to the Bitcoin debate. We're not big Bitcoin adherents or followers. To me, the problem with cryptocurrencies, as somebody who appreciates the benefits of both precious metals and having an asset outside of the financial system and energy, is that it's just a tremendous waste of energy. And I think that frankly makes it unviable over a long-term basis. It doesn't make any sense for us to consume such a vital resource as energy, where we can literally, the more available free energy we have, we can put towards every end of economic growth. It doesn't make a lot of sense to me to then reroute that excess power, of which, of course, there's no ever such thing as excess power, because we would love to use more and more and more in every facet of our lives, to put it towards some abstract mathematical cryptology in order to generate tokens that then can be used as a very abstract means of exchange. So it just doesn't make a lot of sense to me because of the energy side of things. Obviously, there had been the idea of proof of stake versus proof of work, with the hope of proof of stake getting around the energy issue. Unfortunately, from everything that I've seen, the problem with a proof of stake concept is that you remove a lot of the safeguards and protections and security that you get from the proof of work. And so it's not necessarily, a bug, but rather a feature. All that embedded energy in the blockchain is actually what keeps it secure. Unfortunately, it's a tremendous amount of embedded energy. So I don't think that long-term Bitcoin is going to prove itself. Obviously, gold has had a much longer run in terms of being, a sort of monetary asset that exists outside the financial system. And that's really its true benefit. And I think that it will be the same here too. So today, is money coming out of gold and going into Bitcoin? I mean, money seems to be going into Bitcoin, that's for sure. But longer term, I don't think that they're really a potential competitors. The other thing that I think is really interesting, and we saw this a couple of years ago, in 2022, is that gold is perceived to have some benefits as being diversified. And so when other risk assets begin to do poorly, gold can provide a ballast. And what we saw in 2022 is when everything else stopped working, when big tech stopped working, Bitcoin collapsed there as well. And so I would really consider Bitcoin as a tech stock more than I would consider it gold in terms of its asset characteristics. And I don't think that long term it's going to pose a threat to gold. I do think, obviously, looking back on these periods of time where you have these massive dislocations and capital flows out of real assets into financial assets like we're seeing now, they all result in these huge imbalances in the global credit system and the global financial system. And as you work to rectify and bring some of those imbalances back into balance, gold takes on more of a monetary role. And I think that's exactly what we're seeing today. The last thing that I'll say is that in recent months and years, I mean, today now you have the 10-year yields beginning to move higher and bond prices moving lower. But in the last, call it 12 months, there's been, talk of how the bond vigilante just isn't around in the bond market anymore. And part of that is because the government's buying so much of the treasury issuance. And so, basically manipulating yields along the yield curve. And a lot of those feelings of dissatisfaction and of inflationary pressure, instead of being able to manifest themselves in the bond market through the bond vigilantes, have sort of become the gold vigilantes and put a bid under the gold price. And I think that there's probably something to that. So I think that gold will continue to do very, very well. And I think, in every commodity bull market, in every period of time when commodities go from radically undervalued relative to financial assets to radically overvalued, gold plays a serious role. It's always a question of getting the timing right on it. And I think, the timing started last year and will continue for several years now going forward.
Well, gentlemen, this has been a fantastic conversation. So many insights shared. Tell us about Goehring and Rozencwajg, what it is you do, where people can find your market commentaries. Leigh, I'll pass it off to you.
When Adam first came to work for me all the way back, he's a very young man. I think he was only 21 or 22 years old after doing a stint as in the investment banking department of Lehman Brothers. I said, and that was all the way back in 2007. I said to Adam, I said, one of the things we try to do, one of the things I've always tried to do, is that I'm not going to tell you what happened in the past. I'm going to tell you what's going to happen in the future. I'm going to try. Now, when you think about it, that's incredibly difficult to do. And we don't always get it right, but it's something that we strive to repeat over and over again. And I told Adam, when he first came to work for me, I said, let's try to do our research, come up with our investment conclusions, make our investments somewhere between a year to 2 years before they become front page headlines of the Wall Street Journal and the Financial Times. And that's what we strive to do. And just as we established Goehring and Rosenzweig back in 2016, beginning part of 2016, we've been able to do that over and over again. For example, in our last letter, we talked about everyone's bullish on copper. We wrote our first bullish copper piece in 2016. It's a wonderful piece all about renewables and how the article is called the upcoming huge bull market in copper underpinned by renewables or something like that. But that's what we try to do. Uranium, natural gas, and now in oil. We're telling you what's going to happen in oil. No one agrees with us. We had a lot of high profile people saying that we've lost our minds and things like that. But I think we're going to be right. And it's something that we've tried to do. And what's so interesting is by using the pessimism that comes at bear market bottoms where everyone is bearish, the equity valuations are radically low. That's where we try to get involved. And we try to capture the values that market swings present us with. Specifically, we love to pick bear market bottoms. Difficult to do. Most people don't try to do it because it's a career ruiner for more people. But we believe that as we roll up our sleeves, we have enough confidence in our research. It's something that we've been able to repeat over and over again. We don't always get it right, but we get it right quite a bit. So that's what we try to do at Goehring and Rozencwajg. And, if you look at our long-term numbers, our long-term track record is phenomenal. I repeated this strategy, trying to get involved in markets where, especially the equities that are associated with that commodity, are radically low levels. It's produced tremendous returns for us and for our investors. And that's what Goehring and Rozencwajg is all about.
Fantastic. Well, I'll put a link in the description below to the Goehring and Rozencwajg website and X profile as well for people who want to follow along. Gentlemen, thank you once again for coming on the show. It has been a very enlightening conversation.
Okay, very good, Jesse. Thank you so much for having it. We both, Ed and I, really appreciate it. We love doing this for you. So